So we're going to begin the day with the session on Logic's investment and start off hearing from Julia Cook.
And I'll just do the 10-minute, 5-minute.
Yeah, sounds good. And I've got 20 minutes.
Yeah.
Cool. Okay, so thank you so much for coming along bright and early. I'm talking about my current research on intergenerational, or I should say family financial assistance with first home ownership, and I'm talking about it from the kind of angle of investments today. So just by way of background, there's been a kind of growing interest in the role of kind of asset ownership and proximity to assets in shaping life chances over recent years. Several quite influential books and such have come out on this particular topic, and we can see a kind of shift towards focusing on assets, particularly housing, as increasingly important. There's been some interesting work around the impact of that on social class schemas. And in terms of what this looks like in Australia, it can be really difficult to find good stats on how prevalent it is for first home buyers to receive financial assistance from family. This is because they're kind of outside market transactions. In my own research, I've even found people to get around having their pension reduced, giving relatives cash in envelopes. So I think definitely kind of difficult to trace, but one particular kind of public company puts it at 60% of first home buyers at the peak of the housing market in the middle of last year during the kind of pandemic fervour. And so there's been some research that's been looking at the impact of these intergenerational transfers on family relationships, the wonderful work of Druta and Ronald and some other people, including myself recently. There's also been interesting work in this area on how notions of meritocracy are navigated in the context of so-called kind of unearned wealth, and how a sense of fairness is maintained, which is really quite interesting. And so today I would like to kind of look at this area and this context in general, and to consider how young people imagine secure lives in this context. So I'm wanting to look at their kind of future imaginaries, which, you know, anyone that knows me and knows my PhD topic can see that I'm maybe kind of going back to the start a little bit with this particular line of thinking. So I'm wanting to speak a bit today about what I'm calling the relational development of financialized subjectivities. So looking at how financialization is developed at a subjective level, not only for individuals, but for families that are increasingly confronting the property market as kind of extended family units of various constellations. And so in their pioneering work in the early 90s, from fieldwork conducted in the 80s, Finch and Mason focused on family responsibilities and how they were negotiated in practice rather than how they were perceived at a normative level, on the basis that, you know, when they were asking questions around, kind of normative obligations, like they presented vignettes and asked, you know, if in this scenario, do you think that parents should give a young couple money, or should they wait for longer to put a deposit down for a house? And Finch and Mason found that there wasn't really very much normative agreement, and that these kind of scenarios were more, you know, played out through practices which directed focus to the kind of doing of family in this context. And I'm wanting to kind of bring that into dialogue with some recent work on kind of financialized subjectivities, the financialization of everyday life, Langley's work, and a recent kind of iteration of this that looked at the development of financialized subjectivities in the context of property markets. This particular study was looking at Melbourne. And I'm wanting to kind of pose the question of how financialized logics and the conditioning of financialized subjectivities, it is enacted kind of within and through rather than simply upon families. And I'm wanting to do this by looking at some of the family practices, but also by looking at, I suppose, imagined futures. So how young people imagine their lives in the context of the assets that they're wanting to accrue. It's investment properties, particularly in this particular context. And so the empirical study that I'm drawing on is ongoing. So far, I've conducted interviews with 80 people, 40 people that are receiving financial assistance and 40 that are providing financial assistance. About half of these were related pairs, so most often a parent and a child, and then the other half were not, just because as I was talking to my related pairs, I started to realise that to some degree they were potentially holding out on me about the family dynamics, and I figured I need to kind of talk to some separate people as well so that they're potentially going to be a little bit more candid about some of the not so great elements of this. Although some of the most interesting things that I've found so far have been around, when I've been speaking to related people separately, around what they tell me not to tell the other person. So at the end, there'll be a list of like, now don't tell my son X, Y, and Z. And of course I never would, it's an ethics violation, but fascinating nonetheless. And so these people have been in New South Wales, mostly in Sydney, and I'm planning to re-interview the full sample in 2023 next year and then speak to a subset the following year. So it's going to be a really big data set. And in terms of the kind of, what these participants look like and such, about 3/4 of them are intergenerational kind of donors and recipients who have received assistance from, given or received assistance kind of across a generational line, so from a parent generation to a child generation. And then about 1/4 of them are actually siblings, which I'm not going to get into today, but I spoke about that last week at TASA, and I think it's really interesting because it's something that hasn't really come up so much so far. And I also, in this study, I oversampled 4 people from culturally and linguistically diverse backgrounds because I think there's a lot kind of going on the level of culture and in the context of family experiences of migration. And so I've had a really interesting time exploring that. And again, I'm not going to get into it too much today, but that's something that's kind of floating alongside this study. So, the thing that I found quite interesting that I'm focusing on today is the questions that I was asking my participants kind of towards the end of the interviews around, what are your plans and desires in terms of like your future, your working lives, property, like what do you kind of want for yourself, or what are you even on track to achieve? And so I found that the vast majority of the recipients of assistance who had entered the property market within the last 12 months, they far and away wanted to own investment properties. Some of them were taking quite concrete steps, others may not ever kind of realise this ambition, but I think all but 2 people really wanted an investment property and saw that as a really good pathway towards a secure life. And so I think this is potentially coming from the kind of parent generation in a way. 2/3 of the recipients had parents that owned investment properties, and we know this is disproportionately high because the rate of kind of second home or investment property ownership in Australia is about 20%, so very high, but probably to be expected. And I think this signals perhaps a socialization into a kind of culture of housing investment or even of landlordism, which I think is quite interesting. And so this kind of socialization and the way that certain kind of messages and norms and subjectivities were passed on through families, in some cases this was really overt. So in this particular case, this was me speaking to the father of an 18-year-old who had just bought him outright a home, an apartment, and his rationale was that when he started buying properties, he was 25 and he had accumulated 10 properties or something like that. And he figured if his son started at the age of 18, then imagine where he could be by the age of 45. So this is far and away the most overt example. And unsurprisingly, Samesh is a property developer. So, but I thought this was really interesting because it is a very clear, very direct socialization. Like the desire to buy a property did not come from this 18-year-old. It was entirely from the father, and it's kind of started this son on this path. But I found that for the majority of the other participants, I suppose the socialization or the kind of inculcation was somewhat less overt. So in previous research, it's been found that to be seen as someone who's deserving of receiving money from family to facilitate entry into home ownership, there's the need to kind of conduct a certain performance of self as deserving, as responsible, as working really hard. I had lots of young people that were cohabiting with their parents to try and save money and were, staying late at work and like really hustling and like doing extra work on top of their full-time job, and was saying like, oh, my parents could see I really wanted and I'm really responsible. So that's kind of that kind of performance of deservingness has come up. But I found that kind of alongside that, the recipients also were putting forward this kind of shared logic investment with their parents. So they were talking about being very much kind of on the same page in terms of the value of investment. So this was, of course, investment in the property market, but I also found within families the specific types of investments that were sought and were utilized, like shares or property or even Bitcoin, like cryptocurrency, really, really shared within families. And these kind of shared investment practices seem to lead to a sense of kind of shared attitude similarities, kind of faith. And I also found that quite interestingly, the kind of ongoing like value of investment kind of continued after the money had changed hands, to the extent that quite a surprising number of my participants had money kind of moving within their extended families in really interesting ways. I kept finding like extended family savings pooled in one person's offset account, like as a way of kind of reducing, like leveraging funds to assist each other's financial and investment goals. And often it was couched in the language of accelerating, paying off the mortgage to then be able to buy the next property. So that really, to me, was quite an overt strategy. And I found as well that there was something really interesting going on around these conversations about investment that really contrasted with the conversations about money more generally. So I've put an example up here, but this was so typical, especially between the children and parents, that the younger generation had very little idea of their parents' finances and felt very uncomfortable asking. There was not really a sense of whether their parents could actually afford to help them, where the money came from. I guess savings was the consensus. And there seemed to be a reluctance to ask, a sense that like, oh, well, they wouldn't give it if they couldn't, which I'm not sure if that's necessarily true. If anyone listened, I was talking last week at a conference about the scope for financial abuse, whether overt or kind of unknowing in the context of all of this, and that's there. But I think it's really interesting to contrast the conversations around the parents' finances and just how kind of stilted and weird they were, and the reluctance to even talk about and think about it with these really like candid, open conversations about investment. So, the young people seem to kind of have quite an open dialogue with their parents a lot of the time. They really used them as a resource. And they spoke a lot about investments in the way that they didn't speak about like money more generally necessarily. So I thought there was something there around, this shared logic investment, bringing together, like showing that I suppose the families are kind of on the same page. And so moving forward to thinking about like what is it that that the young people who want to buy all these investment properties, what do they want to do with them? Like to what end? I found these conversations quite interesting because I was asking them, but why? Like what for? Or like how would this impact your life? And I found I did need to push a little bit, but kind of gently in this area, and I would get answers that were around being able to provide for my kids, being able to take a bit more mat leave, being able to drop down to point 8 at work and be around a bit more for my kids, being able to go on a holiday once in a while. It wasn't really particularly grand stuff. It was very kind of everyday. So providing for children a slightly more comfortable and leisurely life. And I'd say as well that in general, these were young people in professional jobs. They weren't insecurely employed. They were mostly, because they were servicing rather large mortgages, they were generally quite securely employed. Not universally, but generally. And then we have work-life balance. So thinking about what this kind of means, I'm kind of thinking around the language of a kind of dual welfare state. So this is drawing on kind of Kemany's earlier work about essentially paying larger housing costs earlier in life conventionally, so that you could be in owner-occupied housing by the time that you retire, and that kind of being a pretty conventional life course, and the way that our welfare state has been based. And especially in Australia, if you do not want to retire in poverty, then being a homeowner is the absolute best way to do that, because of various kind of ways that the pension is managed. And underpinning this argument, we have the need for, I suppose, some of the assumptions around the dual welfare state to be reassessed as we're moving from a kind of a wage earners welfare state to a welfare state where some of the population is receiving kind of direct welfare and assistance, and then some is receiving kind of welfare and assistance through like tax concessions, things like the capital gains concessions, all of these like preferential kind of treatments of housing in our tax system. And so what I'm trying to argue here is that we obviously in Australia have an asset-based model of retirement, and this is based on the idea that you retire and you own your own home, and that kind of offsets your housing costs later in life, and then the pension or your superannuation is sufficient to cover your kind of other costs. But I think what I've found here, and what I think is interesting, is the desire to draw on kind of an asset-based model of welfare, and to take advantage of these preferential tax settings prior to retirement. So to draw on assets and investment properties and such during the working life, and I think to draw on them for kind of not just buffering against major shocks such as job loss. Like that didn't really come up that much. The potential kind of worries about the labour market. It was really more around pretty mundane things. And so some implications that I'm thinking around this are that in Australia, arguably not owning a home is a life course risk. Essentially, you're probably not going to have a great time in retirement if you're not a homeowner. But I found it interesting that equally owning investment properties was conceptualized as a way of mitigating and managing other life course risks. And many of these risks seem to be very gendered, and the kind of income and such from investment properties seem to be largely concerned about, or largely imagined as meeting some of the costs of social reproduction, which I thought was interesting. I'm also thinking around the need to think about, I suppose, the kind of unit that's managing these risks a bit more broadly. So in his work on the risk shift, Hacker in the mid 2000s was talking about kind of risks undermining the family, but he was talking about the dual income kind of nuclear family. And I think the intergenerational family is increasingly becoming a site of risk management and mitigation, rather than something that is just being kind of undermined by this kind of shift of risk from government and business onto individuals. And I think that this whole process and all of these things are very much underpinned, or the kind of relationships developing in the intergenerational family here are underpinned by these shared kind of financialized or investor subjectivities, these shared kind of logics of investment that kind of appear to work almost as an extension of this performance of the kind of responsible self that is deserving of financial assistance and should be given that by the parents. And so, next steps. I'm interested. I feel like I have a little bit of a kind of real world experiment on my hands in terms of the timing of this particular project, because there's currently, or going into my next round of data collection next year, there's lots of really alarmist media stories that I love watching while I'm procrastinating on mortgage mayhem and all of these things. And I think I'm not kind of convinced by all of these, and I think there's something to be said for the fact that even the decline in property prices is just kind of bringing them in line with pre-pandemic levels. So I don't think it's quite the crash that people might think it is, but I'm more interested in what this might do to the kind of faith that my participants have in the property market, because from my discussions with them during the interviews this year, they have seen the property market as the site where they are going to accumulate wealth and where they are going to manage the kind of risks that they encounter in their lives and are going to facilitate the type of secure life that they want. And I'm curious about what happens when that seems like less of a certainty, I suppose. So that's all from me, but a big thank you to my research participants for talking to me about some very tricky and personal things. I'm very grateful for that. And thank you to the ARC for funding it.
Thanks. Questions?
Thanks. I've got heaps. It was so nice to hear you talk about your research, Julie. I know a bit about it. It's lovely to hear about it in depth, and I have a million questions. I just kept thinking how far apart this is from the kind of practice and research that I do, like way down the other end of the spectrum that we're going to talk about this afternoon. I just kept thinking, privilege. But then when you were talking about the fact that young people don't actually necessarily even know the financial positions of their parents, I thought maybe I'm kind of oversimplifying it, thinking about privilege here. How much though do you think that this kind of emphasis on investment worsens inequality? If I look at that and think, man, the young people that I work and do research with, but so far away, I just kind of see them getting pushed further and further down. But yeah, you understand so much more than me. So yeah, talk about that.
Thanks so much, Kate. So yes, I think this very obviously has the potential to worsen inequality, but I think there's some kind of slightly more complicated things going on. So to begin with, the point that you made about the young people not really understanding their parents' financial position, I think that's crucial, because speaking to the parents, so I've done this research obviously here, but I've also done a smaller study with a colleague in the UK, and in both contexts, we found at least some parents, generally single older women, that were not in a financial position to give money and gave it regardless for various reasons. And they didn't put themselves into immediate financial crisis, but they were one financial shock away from being in real trouble. Like, one of the people in that situation was in her 70s and worked as a cleaner, and gave her, in the UK, her pension lump sum to her daughter, and had a very meagre pension coming to her, didn't own her property outright. So I'm not quite sure what her future's going to be, but I don't think it's anything positive, in terms of finances at least. And then another person in my study here was an older woman who had continued to work, was using her wages to pay down her son's mortgage. She did not own her own property, and she was living rent-free with a friend. So, like, there was some really, it's the single older women that I'm concerned about in this context. So I think in many cases, yes, perpetuation of privilege, but not universally. And I think as well, like, there's some evidence that these practices can actually leave both the person giving the money and the person receiving the money in not so great financial positions, because if you're getting money from parents to try to kind of just, extend yourself and like buy that property, you're generally borrowing right at your capacity. And so you can very easily end up in mortgage stress, and then end up defaulting down the line. And then for the parents as well, if they don't really have that money to give, sometimes they'll give it anyway. We know that people don't really like thinking about things like needing modifications to their home as they age. So when I've asked, I've tried to ask this quite gently, but when I've asked the kind of older generation, how would you go financing it if you needed to modify your home as you age? A lot of the time the response I get is, yuck, I don't want to think about that. So I think there's some kind of underlying dynamics there.
How much evidence do you think we've got there in regard to recent actions? Do you think that what we've heard is
I think that's something I'd need to think a bit more about, but kind of cautiously, yes. I think especially when it came to, there's some cultural dynamics at play, but especially in certain kind of cultural groups, money moved incredibly freely within the kind of family broadly conceived rather than the nuclear family. So I think the kind of extended family is more and more becoming a really important economic unit rather than being separate households.
the notion of municipal value, sorry, just asking to explain what it's a notion that these activities usually yes well and their other colleagues in contrast to family under the pain of their state, essentially one about sort of community family is reconceptualization of family after having been speak of pains about notion of it's the idea that families increase becomes to business-like loans. So rather than just being site of social reproduction, social reproduction now is kind of individualized, it's strategized in relation to investment loans and flows of capital.
Yeah, I think there's definitely an element of that. That's something I need to sit down and think through properly, but it's definitely kind of in the mix with all of this.
I have a question online.
Yeah, in Zoom. So I'm asking for Miley. She says, "Hi, Julia. Could you please talk more about investing in housing being a gender risk management strategy?"
Sure. Yes. So, so in terms of the, I suppose the rationale that especially some of the older men gave for providing financial assistance, especially to daughters, was extremely gendered. As many of them spoke about, watching their sisters in relationships they were unhappy in that were potentially abusive, and being feeling financially unable to leave. And so the kind of fathers giving money to daughters was very much in the context of, my daughter's never going to experience that. My daughter will always kind of have this property. And in that case, I found it quite interesting that no kind of legal parameters were put in place and no agreements were put in place to try to, I suppose, ensure that if the relationship, because often it was in the context where the daughter was in a relationship, there was not really anything put in place to ensure that if the relationship broke up, that the money would only be going to the daughter. So, the family courts are full of these arrangements going wrong when relationships break up. So I kind of had that in my head when I was speaking to people, but nonetheless, I think that was one of the main kind of gendered risks. And I think in general, some of the recipients also spoke a bit about that and spoke about, I'm going to invest in this, and this is going to mean that I can kind of meet, I can take maternity leave for a bit longer, and I can be around for my kids. And the kind of rationale was quite gendered in that way.
Excellent, thanks Julia. We'll have slight change in the program there from the before Nat. I think ready to go. Oh, cool. Yep. Sorry, everyone. It's not the seamless transition I was hoping for. That's okay. Fingers crossed this works. Great. And okay. Everyone see that? Yes. Great. Okay. Hi, everyone. My name is Ben Hanckel. I'm based at the Young and Resilient Research Centre and Institute for Culture and Society at Western Sydney University. And today I'm talking about a project that I did with my wonderful colleague, Dr. Nat Hendry, from the University of Melbourne. We're looking at, investors and young investors and their experiences. And the title is, It Just Doesn't Make Sense to Not Invest in Your Own Security Over Time, Young People, Financial Security, Wellbeing and Digital Investing. And a few of you might have seen an earlier version of this last week, but I'm kind of building on some of the ideas in relation to thinking about wellbeing. But first, to kind of take one step back, what are digital financial technologies or fintech? So what we're talking about here is the kind of new emerging low-cost fintech platforms. So we're looking at things like Raise, Superhero, Self-Wealth, with very low or no kind of entry fees to kind of get on and use the platform, and then incredibly low brokerage fees as well. These are targeted largely young adult consumers to participate and buy into the share market and cryptocurrency. I think the interesting thing for Nat and I, and this is kind of where the project started, was that at the start of, just kind of after COVID, when everything kind of started shutting down and the world was kind of moving into a different space, there was increasing reports of a greater number of young people investing in the stock market in the first 12 months following COVID. So you see this kind of trading volume globally surged by 50% during COVID. Young people were called the Corona generation investors, with the fastest growing groups 18 to 24-year-olds and young women as well, which is quite interesting. And then you saw this, young people were more likely than older cohorts to invest in new forms of finance, such as cryptocurrency. And at the same time as this kind of, burgeoning or increasing engagement with share markets was taking place, there was these discussions of risks to young people. So risks of copy trading, so young people would just see things online and then kind of copy that and just invest in exactly the same way without thinking about it, in a very passive way, was the fear, as well as blowing, all of their money on investing as a kind of concern facing young people. Kind of to put this in context, and this is not, going to be that surprising for a lot of people here because we've been talking about some of these issues over the last couple of days. I think we kind of when we're talking about young people, young lives, we're talking about what I find useful is to kind of talk about intersecting crises. So it's just not the pandemic It's the climate crisis, it's housing unaffordability, which Julia just spoke about then. It's the kind of persistent structural inequalities, cost of living, and precarity. Cordova and colleagues have recently referred to that as unsettled futures. So this uncertainty young people are facing, particularly in relation to work and I guess finance, within the life course. And so this does make it more difficult, as Davis and Cartwright have argued, to stick to traditional life course scripts and actually engage and negotiate some of those spaces like housing that were kind of expected and are expected of young people, I guess, throughout the life course. So you have this kind of anxiety and that's kind of been heightened by the pandemic. But at the same time, and I think this is quite interesting, there's also these expectations to kind of sustain and create the entrepreneurial self, the kind of enterprising self, the project in progress, and kind of making it in the world, which is kind of young people are kind of entering into, particularly, I guess, middle-class young people, but young people more generally, as well as this like aims for future job flexibility, which is kind of meant to be seen as kind of being successful in the job market. Today, I wanted to kind of think about a little bit of the kind of, I guess, the why of why young people are investing. So I'll kind of talk through how young people are investing and what it kind of looks like in practice, but also the kind of like reasoning behind it. And for a lot of young people, they kind of articulated the sense of a future well-being kind of imaginary. And I guess this is where it connects quite well to Julia's work as well. And if we kind of think about well-being, Cahill has kind of spoken about it as quality of life. Others, and Amartya Sen, who's a political philosopher, I guess, talks about being able to lead a life one has a reason to value. So this idea of well-being as a state in which you lead a life that you value and enjoy. And I think I'm really interested in kind of how some of these like well-being discourses, these expectations of being able to engage in well-being kind of are enacted and practiced by young people. And, people like Julia Coffey and others have kind of spoken about how do these kind of well-being discourses kind of come into the lives of young people. And I want to think through investing as a practice of future well-being and where that might lead us in our thinking. So to give you a bit of an overview of the research project, so we recruited retail investors, so people who said they were investing. That might have also been, or usually was as well to some degree, in crypto for a lot of participants, but we're looking at the Australian stock market. And we asked people, recruited via social media channels that included Facebook groups, higher education student mailing lists, as well as looking at I guess the Facebook groups are kind of looking at investing kind of investing groups. So there's the Equity Mates podcast. I think we kind of recruited via there amongst a few other channels. So we had 5 focus groups in total. 26 young adults participated who were 19 to 30 years. And this happened last year, although it doesn't seem like that long ago now. So just to kind of talk through what it kind of meant to kind of learn to be an investor, and I think Natalie's going to pick up on some of these, on some of this as well, but kind of learning meant, I guess, it was done in kind of formal and informal ways. So formal in the sense that some people were studying finance, some people had very structured kind of processes in place, but often it was quite informal. So it was incidental. I guess they were driven by kind of interests in the stock market, in kind of learning about what it was all about. At the same time, they found out information on fintech platforms, which offer resources about information in relation to what investing means, how to kind of do it, social media, podcasts. I think our podcast, we have a couple of participants who spoke about listening to 15 hours in a week of podcasts, and then I think the most was 16 hours in one day. And then we also had, which is interesting. Well, they were also doing a casual job, so they kind of put in earphones and kind of listened to podcasts about investing, as well as memes, books. So these things kind of all interrelated, as well as talking to friends and family, particularly fathers, about it and relatable others. So we kind of frame this as in our work as digital finance cultures and this kind of engagement in a digital finance culture. So this kind of talks about how they learn and talk through social media and digital technologies to discover and I guess sustain shared but not singular values, norms, behaviours and ideas about finance and investing. So they learn all these things, which includes practices as well as the media and technology that enables them as well. So how do kind of the affordances of technology make these things visible in people's networks? And so that can include, I guess, the kind of promotion of some of these fintech platforms through people's social media feeds. And we're kind of interested in kind of, how it teaches young investors particular ways to kind of understand money and finance, and kind of the norms around finance investing that kind of emerge. So what did we see? So for our participants, they really saw that they had this income of some sort and they wanted it to be active. They spoke about how it needed to do something. You've got Daryl here. I was just looking at my bank account and I was like, where can I save this? Where should I put it? And then kind of, he spoke about that it wasn't good kind of to put it into a savings account. It's like, I might as well be losing money if I'm putting it in there in a high interest savings account. So they wanted it to go somewhere and do something. And that was kind of a impetus for starting to invest. And also that their parents, and I think this is an important point that kind of links to what Julia was talking about. Parents would say, just go buy a house or something similar. And they'd be like, well, I can't really do that. I don't have the money or capital for that. And so they're like, well, I need to build up some capital first or go and find somewhere to kind of like generate that capital before going down that path. So in terms of the way they thought about investing, they saw this as a lifetime thing. I don't think they saw it as something that they would dip out of necessarily, but it was going towards certain things. So they saw investment as something that was allowed to kind of be a risky space to kind of play in a little bit. And when I say that, I mean they invested in more what you might call more risky type of shares, which is the kind of non-ETFs, the exchange, like not exchange traded funds, which they saw as allowing them to be a bit more risk averse later in life. So often it was this kind of age, like 30 was kind of the age in which they would say, oh, I would, kind of be more responsible financially with the investments. But then at the same time, they were kind of really being careful that they wouldn't put all of their money into like risky investments. It would be this kind of back and forth kind of, I'm being careful, but being more willing to be more risky prior to 30, if that makes sense. So kind of after 30, when one of our participants told us that they had to have everyone should have their life all together by 30, which made me feel a little bit, anxious. They spoke about how then they'd go into this full-time work, moving out, starting a family, and then at that point, they'd stop being as risky with some of their investments. So you saw this inverse relationship between age and some of the risky investment strategies. So youth was kind of seen as a potentially less dangerous time, I guess, to kind of make some of those high risk investment decisions. But for them, when they spoke about it, they were talking about these long-term investments, long-term timeframes, these 10 to 40 years in which their investments would kind of come into fruition. But they also spoke about it as being fun and enjoyable as well, something they would enjoy doing and participating in. They enjoy going and researching. They enjoy going and finding out information about investing. So in terms of what they were doing, I guess here we've got like how they were investing for the future. A lot of people spoke about wanting to become financially independent. As Jenny says here, to be able to look after myself in the future, my family, and not be dependent on the traditional 9 to 5. Dennis says it was about being in control, so having a bit more control over my financial situation and taking away some of the stress. And we heard this kind of come up quite a bit around that sense of wanting to feel like you have some kind of control. And then there's, as kind of, I guess, Jenny spoke about too, about the work-life balance thing. Aya kind of talks about, I like the idea of having a bit of money so I can do the things like take an extended break from work if I feel like it. So there's this real focus on this future well-being or future, all right, 10 minutes? Yes, okay. There's this real focus on future well-being and kind of focusing on financial independence. So being able to be able to kind of like manage your money at this future point without having to rely on anyone, this sense of security. So as Reese says here, I don't have to spend every day thinking about, I've got a credit card payment coming up. Am I going to make it? Just having a bit of a buffer. So there's this real emphasis on kind of like using investing. And I kind of want to think about this in a little bit in a moment as a bit of a side hustle so that you don't have to worry about some of the debts that you have, or using it as a buffer to kind of alleviate some of the future, I guess, problematic feelings you might have or non-well-being in the future. They also spoke about very much, I guess, kind of long-term upper middle class or middle class aspirations. So these ideas of home ownership, job flexibility, life enjoyment, and early or stable retirement as well, which I think it fits in very much with what Julia's participants were kind of saying. It wasn't that these people want to be kind of, I guess, the next, Warren Buffett, Jeff Bezos. It was very much this kind of trajectory that was, I guess, within a certain class lifestyle. Also what we found, and I think this is quite interesting, is very gendered differences. So, well, a lot of them spoke about wanting early retirement. I guess a lot of the women wanted to respond to mitigating gender inequities in pay. They wanted more independence, often from a future partner in case they needed that, as well as increasing the retirement savings, which they feared not having enough. And men were not speaking about this, as these were not concerns that were coming up for them. So here's Aya kind of talking about this. She said, and I think already a couple of times financial independence has been a term that's been used, and I think that really appeals to a lot of women. This idea that we don't need to have a husband or rely on a man or rely on family members or whatever we can, we're just as capable as other people, and that, yeah, we can take things into our own hands a bit. So you see the sense of control, independence, this sense of security, but also being able to like not be dependent on someone and being able to like carve out space in the world for yourself. I also wanted to kind of mention that I guess the ways that ethical investing kind of came up into these discussions, because I think it is interesting, and had questions about this last week when I presented some of this work. So ethical investing kind of like, there are kind of two sides to this coin. So I think Andy kind of talks about how I feel more comfortable knowing that my money is going towards something that I value and believe in. So this sense of, yes, I want it to go to something that is important, but at the same time, it's a kind of a growth area as well. So I want to jump on that and be part of that growth area because that's going to increase in the future. So it's kind of this sense of I want to do it, but it's also like how's this going to fit within my strategies for asset growth over time. And then the other kind of, I guess, narrative that came up around ethical investing was how it was a bit difficult because it's actually quite hard to know what is ethical and what is not ethical in some of these spaces. So Grace talks about this. Grace says, I think it's a bit hard with ethical investing because I quite like it in theory, but you know, some of these ETFs, so the exchange traded funds that sort of say they're ethical, it's sort of like, well, sometimes it's based on exclusion criteria. Like sometimes it's sort of, you know, it's around things they don't do. Sometimes it's around things they do. So kind of that sense of, I don't really know exactly what the criteria that's being used. Grace then goes on to talk about in that second part of the quote, how she's focused on climate change or concerned about climate change and renewable energy. But then at the same time, there's greenwashing going on too. So it's like kind of navigating this space, but also accepting that actually maybe it's quite difficult to be an ethical investor in this space. And I think that's something interesting for us to kind of reflect on and think through. I think more broadly, I think for the kind of like argument I'm making is that participation in digital finance cultures communicates to young adults that the risk of investing is not starting to invest at all, and there's kind of the expectation that they should do this when they see this in I guess the digital finances cultures, the feeds that they participate in are saying they should be doing it. So Jenny here says, I mean, waiting like 10, 20 years is probably the biggest mistake most people can make, rather than just losing $500 on a really bad investment. So actually getting burned, as they kind of put it in their terms, is okay now for this long-term gain. And they see long-term gain as being an outcome of investing. And as Anders says, it just doesn't make sense to not invest in your own security over time, which brings us back to the title. Great. So really just some concluding thoughts. I might actually finish a bit earlier as well. But I think the more I'm thinking about this, and based on some of the conversations yesterday, I think it's the investing occupies this kind of side hustle for a lot of young people. They're carefully negotiating how to, I guess, invest in a way that's not going to completely impact their overall lifestyle, I guess, and current well-being. So they're investing a little bit more riskier now, often with the potential for the fallback. To fall back on parents, if that's an option. But the idea is you become less risky as you kind of participate over time. But there's this well-being practice that's focused on this imagined future where you will have potentially greater well-being. And I think that so the futures life course scripts that they imagine are entangled with current contexts of insecurity and aspirations to lives they want to have that will have meaning and value. So they're considered not yet accessible, but if they just wait, they will attain that future well-being. And I think this sense of waiting that comes into these into the discussions, into the narratives, is something I really want to, I guess, kind of flesh out a little bit as I kind of progressed with this project, which is still kind of forming. We haven't developed up the paper entirely for this. So I really want to think through how waiting for future wellbeing is kind of this critical space for young people who are doing this investment activity. As I said before, they aspire towards this upper middle class habitus, which is seen to produce well-being, and there are these different differentiations in aspirations, which seem to be reproducing variations in gendered outcomes over time. And I guess the kind of like where this all kind of takes me is to kind of think through, there's this kind of complex kind of tensions kind of happening here. On the one hand, there's this increased agency. So young people have this access to greater financial information, allowing them to participate in informed decision-making and be engaged in careful investment or investing risk management strategies. So they're participating, they're using the spaces that are available and using the platforms that are available. But at the same time, they're kind of participating in a system or a structure that's also kind of perpetuating a system which is kind of problematic and doesn't really resolve the structural issues. So there's, balance work on cruel optimism, I think, is quite useful here to kind of think through participation in something that might be kind of continuing and perpetuating the difficulties they're already kind of living with and might not all lead to all future well-being for everyone. I will stop there, yes, and just open up the floor for questions. Great, thanks, Julia.
Thanks, Ben. So one of the things that's striking me, and which you did actually emphasise earlier in your presentation, but also Julia emphasised in hers, is that the aspirations that are being like that people are working towards when they do all of these things are actually kind of mundane, as you say, like they're not aiming to be super wealthy. So we're in a situation in which aspiring to secure financial future as a realistic proposition has been seen as a form of privilege. But actually, historically, it was an entitlement of citizenship to be able to expect this, to have a secure retirement as something that you just kind of rely on. Whereas what you seem to be tracking here basically is the increasing financialization of basic social reproduction as it's enacted. So yeah, these are middle class young people. But I think there's a question here about how about the nature of class here and the degree to which these aspirations are as kind of upper middle class or privileged, or I mean they certainly are, right, in the sense that so many people are looking at just like total devastation in their futures if they can't get into asset market. But is there also maybe kind of a transformation of the nature of class going on here rather than just kind of conventional class kind of aspiration?
I guess short answer, yes, probably. That's a big question, Dave. But I guess yes. I guess the way that young people are kind of imagining this future, like I guess it's also kind of holding a position as well. So if you're kind of a middle class young person, I guess there's this kind of like a way to, I guess, investing for these young people is a way of kind of holding this position. Like it's the fear that actually they might slip off and might slip off the slip out of the class space in which they currently occupy. So maybe really this isn't about an upper middle class habitus, but maybe it is just the middle class habitus that they're trying to sustain and stay within. Not sure if it disrupts the way we think of class. Maybe it makes it harder to kind of move into that space and sustain a class position in that space. But I think it's a really interesting reflection.
Thanks. It's great. Can you just talk a little bit more about this sort of this contradiction, or at least this tension between their risk appetite for investing, earlier in their 20s and after the 30 that they're going to slow down or it's going to be a little bit more sedate with this idea of well-being? Like there's all these tensions that are going on here. Like it seems like they've got a higher risk appetite because, let's face it, that's the best time to have that. We're earning potentially so much longer. I just wanted to develop that a little bit. Like they're waiting for their well-being that may not eventuate because of the riskiness in their investment.
And I guess that's the paradox here as well. It's like they might be forever waiting because it's like, well, what are you waiting for, and when does that imagined future ever come. So it's that kind of like, maybe you're always kind of on a trajectory of waiting for well-being. And I kind of was thinking about, well, what's this kind of doing in practice? In relation to the kind of risk aspect. So it is interesting. I think for a lot of the young people in their 20s, they saw their parents or some kind of family support as something they could fall back on. So if this thing didn't work out, if they lost all their money tomorrow, they could actually fall back on parents, or it's okay because I'm in my 20s and I don't have any family, I don't have anyone to kind of take care of. But I guess as they saw it in their 30s, and we actually had some young people in their early 30s as well who were starting to do some of that caring work, and they were starting to negotiate and renegotiate their investing habits and behaviors or practices. And so I think that was interesting to see where they were doing that work to shift, I guess, risk a little bit so that they could actually accommodate and not be in fear of losing everything. I think there was like kind of I'm okay with being a little bit more at risk of losing things in my 20s, but as soon as I kind of take on these take on the kind of life course kind of like stages that I'm meant to kind of take on, and more responsibility, more accountability, full-time employment, house, then I should start renegotiating that risk. Yeah. Thanks, Marla.
Another question can you?
Yes.
So Marnie, good check. So it's Clive and Natalie, it's participation. Just wondering if any of the participants address the idea of market failure that another GFC might happen, or if it was just a total faith in the longevity of the market.
I think it was the faith in the longevity of the market. Like when they spoke, they spoke about kind of hiccups along the way, but it was almost seen as like, oh, you don't have to worry about that because you leave your money sitting there, and over the long term it grows. So this kind of like 10, 20, 30 year kind of plan. So if I want to retire early, the market will grow. It's just it was almost like common sense. Nat. Yeah. So there's this. Yeah. Yeah. Oh, okay. so Nat was just kind of saying how there was this kind of what they would describe as kind of that portfolio diversification. So they put some money into kind of emergency funds. There was the just in case things did go wrong. But there's this kind of, so there was, and I think that was where they kind of thought about, well, some of this money will go when I'm in my 20s into much riskier kind of investments and then change over time, but it was only a percentage of their portfolios. It wasn't the whole portfolio into kind of a riskier kind of investment, I guess. So there was this kind of portfolio diversification, but at the same time, they did see the market as kind of growing over time, and that idea that it wouldn't make sense not to invest over time.
Last question, Ben. Thanks, Ben, and thanks, Nat. I just wanted to know who are the women, and I just want to riff off what you Dave talking about earlier. So you said holding on. I think about they're almost like trying to get the middle class from the tertiary education. Almost like holding, like they've gone to university, they've made a decision. You know how shit that like. This is almost like they're way of no, I'm going to go with this.
No. Yeah, I would say most women were tertiary educated. I'm just trying to remember. I think we had quite a large number of them were tertiary educated. And they were kind of thinking through those kind of narratives where they'd kind of seen, like, I guess, older women in the labour force not having enough for retirement, concerns about being dependent on partners and then kind of losing out later on. So this was in some ways, like what you're saying, kind of seen as the alternate route or additional route. Maybe it's the kind of additional route to kind of like adding something that would buffer them in case things didn't go well for them in the labour market.
They talk about
just trying to remember. They did, didn't they? Yeah. They spoke. Yeah, they did speak about maternity leave, and that was kind of part of that. Having periods off work and being able to be like accommodate time off work. So investing kind of enabled you to kind of do that at some point in the future. Yeah. So there was that kind of narrative that emerged. Yeah.
Awesome, thanks, Ben.
Great, thanks everyone.
Yeah, the points about women were interesting. We also had 2 women in the study who ended up being in a relationship, and that just so much for our random let's pick people based on demographics. And they kind of had their whole little way of doing investing together and analysing it, and it comes up in this too. And they also ran one was a photographer and one did a kind of record label or distro, and it enabled them to be able to find a way to create a more secure future, given that the creative world that they were in valued, kind of had an anti-capitalist bent to it. So I'll come to some of the points about them later in this. I'll just reload this as the computer's telling me to do that. Beautiful. Hi, I'm Natalie. I'm from the Melbourne Graduate School of Education from the University of Melbourne. Thanks, Steve, and the Newcastle Youth Studies Centre for the invitation to come up. I really appreciate it, and I'm sorry I wasn't here yesterday. I'd like to thank my colleague Ben, who did a great start to this and also saved me from setting some of the scene about our methods. Some of what I am talking about today also draws on some digital ethnography work looking at wellbeing culture, wellness culture, financial podcasts, and then the financial cultures work that Ben was talking about as well. I also want to thank Angel Zong, who from RMIT, who was also part of this initial study as our finance person. It was really interesting getting her perspective as someone who hadn't done qualitative empirical research, which is always a tension when you're working with folks that spend their time analysing stocks. Thanking RMIT for funding this fieldwork so we could pay participants, Melbourne Graduate School of Education for allowing me to continue in this space. So I've always been interested in how popular culture, subcultures, other cultures shape pedagogical potential. So while Ben was talking about some of more the sociological grounding for the work that we're looking at, I'm especially interested in what this means in terms of pedagogies. And one thing I've noticed with the work I've been doing looking at digital cultures, whether that be about mental health, wellness, Fitspo stuff, learning in general, is this idea of kind of being in a digital culture, lurking TikTok, scrolling through Instagram. People will talk about as, oh yeah, I'm on there and I'm learning. So even if they're not actively there on there and they're learning, like, oh, I'm on TikTok and I'm scrolling for 3 hours, but I'm learning stuff. What are you learning? Oh, I've learnt this and I've learnt this. Did you want to learn that? Oh, I don't know, I don't mind. I mean, the algorithm found me. I'm in my niche. It's awesome. I got rid of the stuff I didn't like. I was about to say something really inappropriate there, holding it together. But this kind of like popular vernacular of learning as a way to talk about digital participation. So there's that kind of thing I'm trying to tease out and what it means when people think that they're learning through participation, but also more formally, what is the pedagogical role of participation in digital cultures? And in some ways picking up things that Julia and Ben both spoke about social reproduction. How do people become financialized subjects in this kind of context? What does it mean to kind of learn to be of a different class or to be in a particular class experience as well? So it isn't a groundbreaking claim to say that social media has sustained and digital technologies haven't enabled the rising young adults investing on both the Australian market and more broadly globally. We know that young adults jumped at the chance to invest on the global market, 3.3 billion in February to March 2020, compared to 1.6 billion in the years before the pandemic. So at least in Australia, while the rise was fueled in part by the pandemic, so people having JobKeeper payments, staying at home, not going out, some of the gambling that they might have done more socially while going to an event or the pub with their mates, they're not doing, especially in Melbourne because they're in lockdown. Some of that has been transferred onto the stock market. But in Australia, we have a really interesting context where things like immediate payments from bank to bank have enabled people to be able to immediately put their money into their digital broker in order to immediately then go and buy something on the stock market if it's within the time that the market's open. So it's not only the pandemic that's enabled this, but the ways that the platforms have shaped our capacity for real-time immediate transfers, for us to be able to see those transfers visually. So in the dashboards, I'm thinking about the Being With Data book as well, and how these things are dashboard and what that means for us pedagogically to see those movements in real time, for people to track things in real time as well, as opposed to perhaps nobody talked about the old days of buying stocks, but you'd ring up your broker, they would buy it, they would then tell you've bought it, and you might get something in the mail to say your money's up or down too. So for young people too, that entry point coming into buying where you can use micro investing apps for $1 and buy a small parcel of a percentage of stocks, or starting off at $500, which for the young people we spoke about isn't that big of a deal. Like $500 for some of them, that might have been a bender, even if they're working packing fruit. I think that was the participant that listened for 16 hours a day to finance podcasts. So these are not necessarily professional young people who are sitting at their desks watching the stock market while also doing whatever else you do in front of a computer. The other thing I want to mention before I talk about how people are learning in this space is that after this project, I had coffee with someone who runs a financial education, mostly about investing platform. They're kind of second in charge. They've also started doing a lot more podcasting. And she leant across the table and whispered, do you think it's that bad? Like, are young people losing that much money? I mean, they're 21, it's just a 500 here and there. And I said, look, I don't know their lives. I don't know what that $500 means. But there was so much stuff in the media at the time, particularly on Australian Financial Review and The Australian, where people were so concerned about all these 20-year-olds losing all of their money, even though there was no evidence that one was all their money, two, that it wasn't the kind of disposable income that they might have had that perhaps could have gone to gambling, records, knitting in my case, clothes, all these other things that we might not have this fear or worry about them losing this money in that moment, depending on what else is happening in their lives. So keep this in mind if you think this is a problem or not, because one of the big problems that I'll talk about is about what we do with these young investors, and does there need to be an intervention? So Ben mentioned the way we've been talking about this as digital finance cultures, and trying to bring together a lot of the sort of cultural economics, cultural studies, media studies, comms and sociological literature on how different norms and values are shared and shaped through cultural participation. It's always going to be the thing I go back to, and trying to make sense of what's different about investor culture in Australia compared to other contexts too. We know in general Australians have poor financial literacy. It comes up on the Hilda study again and again. International students coming from parts of Southeast Asia, China, will say, oh, the Australians don't know anything about money. They don't understand compound interest too. So you've got these different kind of competing ideas coming through. For some of the people that we spoke to in the focus groups, and this comes up a lot on Instagram, it's almost like, oh my God, I didn't believe that that's what investing meant. That investing is not Wolf of Wall Street. It's not this thing that you go past those weird looking offices that say investments, that it actually is something quite mundane, that they don't link that to superannuation either, that superannuation is an investment. I can put money in a thing called an ETF, where they group a bunch of different stocks together and other kinds of investment products, and I can invest into that. How come nobody told me this? And the next thing they always go to is, why didn't we not learn this at school? We learned about how to write a check, we learned about budgeting, maybe a bit about a mortgage in general and what a percentage is, but why did we not learn about investing? Interesting, in the Australian VC health curriculum, you learn all about the value of health insurance. So, yeah, which we haven't been able to get out of the curriculum given the value of health insurance. So given this giant rise of folks, particularly young people, particularly young women, joining the investor ranks in Australia, lots of media attention, as Ben said, was focused on, are they copying, are they sharing, are they looking at platforms where you can see other people's moves and what they're selling and buying? They were worried about the taxation implications, as if these young people were sitting on 100, 200K a year and had all this complicated tax when most of them got their parents to do the tax. They were concerned about these young people not diversifying their portfolios. They were concerned about this playing the market and trying to gamify it. And they were concerned by that kind of pump and dump schemes, particularly across subreddits where people would say, oh, you know, this stock will go to the moon, buy it, this crypto, this coin will do this, buy it, and then people disappear, they take their money and you're left with nothing. The Australian news media was really worried about the after effects of GameStop and the subreddit Wall Street Bets as well, and platforms like TikTok banned financial advice, which was a shame because a lot of it was quite mundane. You could go and type your age in, and it would say how long you had to get this amount of money if you put this amount of money in. Someone would just show you this graph with a cool looking pointing thing at the side. So while there was genuine concern about young people's financial lives, a lot of it really emphasised that there needs to be more education. And I hate it when anyone says, oh, schools need to do better, because I don't know if this is the right place for this to happen. And also schools have enough to do. ASIC, which is the Australian Securities Investment Commission, so they're the ones in charge of the stock market in Australia, put out some really useful advice for finfluencers, so finance influencers, telling you, if you say this, I'm going to share with you 5 long-term stocks that do well and which you should buy and hold. That is financial product advice, and according to the Corporations Act 2001, nope, you can't do that unless you're qualified. So a lot of these changes predated the kind of rise in this finfluencer culture, but were following the 2018 Royal Banking Commission as well. So there were big changes, and financial advisors were pretty frustrated because they had to go to uni and do another certificate to learn things like this. When I was reading through them, they're all very obvious kind of things. It's almost like reading the APRA, the health practitioners' guidelines on what's okay and what's not okay. They never get into the messiness of it. And given that platforms like Refinery29, which is a fashion platform, they were showing things like this is what people did with all their money and what they invested or what shoes they bought or how they budgeted. It's interesting that ASIC wasn't even touching this kind of lifestyle information that was coming through, but instead just going straight to this really dull stuff that doesn't even cover. So most of the finfluencers that were genuinely trying to create a space for people to learn about finance went, nah, I'm just going to be super careful. I'm going to get rid of all my old content. I'm going to just tell people the wonders of compound interest. So through the focus groups, and I've got some quotes from the next lot of people, Ben and I were trying to make sense of how are people learning about investing in this space? Where does that align with our theories about social learning and digital learning? Where does it not work? And I haven't really been able to find a kind of theory or an approach to learning within digital cultures or through digital technologies that quite gets to the juiciness of this sort of stuff. A lot of people will go back to let's use communities of practice, Lev's work, and put it in a digital context. Or let's look at George Siemens' work about connectivism, and you need bits of information and you put it together. But there are other things happening in terms of datification, financialization as well, and how platforms are shaping possibilities for learning that I don't think the theories are quite getting at. Here's a quote from Cherry about learning as active participation, which is one of the things that Ben mentioned, so I won't touch on it too much. It's not only that young people had to give it a crack, so it's like, oh, if you want to do it, you have a go, it's easy, you download this. It's also about actively participating in that culture. You start to follow a few things on Insta, you might join a few Facebook groups, you may or may not pay attention, you'll know who Elon Musk is at the time and Dogecoin and the rest of it. And people are starting to get into it. There's a kind of a feeling that this is something that's normalised or valued with others the same age as you. There's also something here about balancing and curating learning. So some of it was about just letting it flow through your feeds, chatting with other people, adding different podcasts that you subscribe to. This kind of aligns with that news will find me literature, where people are not actively going out buying the newspaper or sitting down to open up the Sydney Morning Herald on their browser, but it comes through their Facebook, it comes through their Twitter, that comes through their Mastodon, I assume. They might follow something on Instagram, a journalist they like, and you don't really need to read the newspaper because it's going to find you, and the algorithm will shape that in that way. And if not, if something big happens, you're going to hear about it. So there's some intentional things in that kind of old school liberal educative subject where people are going to learn. I'm going to read the book. I'm going to read The Barefoot Investor. I'm going to listen to this podcast. I'm going to be a big fan of Equity Mates. I'm going to have 20 tabs open and I'm going to find all the information. But there's also something that sort of comes unintentionally through different platforms that young people are finding useful. There's this idea of balancing information. So even if you've made a decision about what to buy or sell, you kind of need to just check on it. So you open up 20 tabs, see what other people are saying, which is very similar to the plastic surgery groups that I follow, where even if you've decided to have a particular surgery, you just need to know that, are other people doing it? Does it feel right? It's almost like that screenshot thing where in the dating apps literature, people take a screenshot, show others, what do you think I should say back to this? That's what I was going to say anyway. Okay, you've all helped me out. A kind of Greek chorus that enables you to participate. There's other ideas about this idea about dialogue and almost a kind of rhetorics argument, which I've never really studied, but I'm trying to play around with, where it's not even knowing what something is, it's just your participation on eavesdropping on a type of conversation. So if you're hearing two people say, oh, this is good about this company, this is good about this company, this is bad, this is good, that's enough for you to feel like you've participated in a critical conversation about something. And I think that really shifts this idea about, where do your values fit? Like, you're an open-minded person. And the last quote still gets to me, the last bit. This is Joshua 22, and he says that it's this ability to think deeply on a 20-minute podcast. That's my bit. And, the people are talking about potential risks. And these people, these podcast people, they're very good at what they do. Same like I listen to people like Joe Rogan, just people really good at conversation, leading people to different points of the conversation. And I try and listen to a wide range of people as I can. It's just people who are really analytical and thoughtful. And the others in this focus group kind of nodded along like, oh yeah, it's that thing of just getting enough of this perspective that you've had these diverse views, but they're not actually in conversation with one another. And the Joe Rogan thing just kind of went off as a blip too. Like, oh yeah, we all, you hear some other opinions. There's another one here about, your friends don't get it. So actually joining Facebook groups and eavesdropping on them gives you a sentiment analysis of what's happening in the market. Other things about the relatability of influencers and podcast hosts, just for you to get a sense of who they are and how you might follow them. I'm more than happy to share some of these quotes later on too. I just want to jump to the platforms bit in the last 2 minutes. The last piece that I'm trying to make sense of is how some people used, I think someone had like 8 different platforms at one point. They all kind of do the same thing. Most of them you buy stocks on the Australian market for different costs, and there's different other fees associated with them. But they would try different platforms to learn different things. Or this one gives me different analysis. This one's just easy because it links to my Commonwealth Bank account. This one I'm curious about. This one also gives me access to the US shares, even though all of the others now give you access to the US market as well. And this sense of research through the platforms, just giving you the same info or the same info you can get on Morningstar, but just in different formats too. And it was never a choice of, just one will do. Some of our more professional investors who might be working in the finance industry who are maybe 30, they might have used more traditional ways of learning by going to AFR and having one platform. But for others, it's kind of, let's just try them all out and see what comes up. Some of them were interested in looking at the social trading functions as well. But for others, it was that sense of just setting forget, out of interest, seeing what's happening, watching the investments go up and down as a way of being kind of apprenticed into the idea of the stock market and to sitting with the risk, a kind of effective practice almost of, okay, you've spent 3 months watching it go up and down, you've been freaked out here, you've been excited here, you screenshot this, and now you're okay, now you're a bit bored, and now you're off doing something else. And maybe you're interested in crypto now, actually maybe you're into gardening and plants now. So there's a kind of temporal element to this learning too, that the platforms will be used at different ways and different points. And again, this idea of a feel for the market and risk. So this idea that, if you don't have enough information or you don't have enough of an understanding of the lingo, you might step back until you understand. You might ask your mates, but this sort of sense about being comfortable with learning in this way too. And it's not something that necessarily was easy for them to articulate so clearly, like, oh, I know these 5 things and I've done this e-course, therefore I'm fine and off I go. And then here's an example of Casey, who spent a lot of time trying to curate all of her things. The only way I can think about this in terms of theorising it is Carolyn Pedwell's book about effective habits, that habits are both intentional, something you actively want to do, but also they're things that are unintentional, that kind of effectively simmer in the surface, almost the way you learn song lyrics just by driving around in your car too. So you kind of actively are singing along, but other times it's just kind of there as background noise. Joe Rogan as background noise. Equity Mates as background noise. But that's the only kind of thing I found that kind of fits to some of the non-traditional direct ways of learning. So thank you. Ben and I have a report that's got some top-level findings, and now we're trying to think through other bits and pieces. So if you have any suggestions or ideas or something you think we're missing, we'd love to hear about it.
Maybe not a question, but just a reflection.
Oh, I love a reflection.
I love the way that you describe the nuances of what young people do, and it sounded to me so sophisticated. I mean, I was sitting there thinking about my own knowledge about my superannuation, about health insurance, and how bloody oblivious I am. I have never ever put anywhere that amount of thought into it, so that it's easy for adults to get hysterical about the risk, but gosh, I was sitting there thinking,
there's something social, like you kind of hear about from your mates, and I know the 2 women I was talking about before, they and a few others felt a bit dirty telling other people that they started investing. So unless you're with the finance bros or talking about, your mortgages or whatever at the pub, it's a real kind of subtle, it's like, oh, I'll just read this or I'll look at this and then I'll talk to others. Oh, then they invest too. Oh, and then it opens up a whole world. It really does feel like when I talk to people about living with mental illness, like, oh yeah, I'm not going to tell anyone about borderline, and then, oh, okay, it opens up this space. So some of this is quite, just what it's like to live in a world where certain things are shamed and stigmatized. But it is quite complex too, but schools are not going to be the answer for fixing any of the uncertainty here.
Hello, good morning, everyone. I'm Brian.
Hi, Brian.
Hi, Natalie, and then thank you for your presentation. It's very interesting, and it's really true. There's a lot of complexities. I'm not doing this kind of research, but in my mundane everyday life, I use TikTok, and to post my dance moves and whatever that is. But my question is something to do with, does this sort of financial or digital financial cultures really inspire a lot of young people in Australia? Because in the Philippines, there's a lot of talk about cryptocurrencies, tax in the Philippines, and then we have NTF. I was actually tempted to engage in NTF, like post your drawings and you can earn from it. And then, but I'm afraid I don't have that guts because there's a lot of just intellectual properties, ethics, and so on. And so that has something to do again with this particular uncertainty, because in the Philippines, based on anecdotal observations, I've seen a lot of young people engage in digital finance and investment during pandemic. because there's not a lot of jobs.
Yeah.
So they engage in this kind of vlogging, and a lot of social influencers have earned a lot, and they built mansions and houses. And I think a lot of young people now are inspired by it. But the thing is, there's risk and opportunity. There are opportunities, but there's also risk. Particularly when we talk about the values formation, because and even kids, they use this platform to show, things that which aren't supposed to be shown. So I was wondering if does this inspire the Australians, and how do these people navigate this risk and opportunities? So thank you.
Yeah, I was talking with ASIC last year who are doing A/B testing on their website, which is interesting. And they couldn't quite get the niches that the finance bros who are sitting on Reddit or Hot Copper for, if anyone wants any apparently poor investment advice, they might be kind of also tied up in that thrill of, what it means to have a lot of money, and it's kind of a game and all the rest of it. And then you've got other groups of people who might be more interested in a kind of wellness spirituality where investing enables you to live an abundant life. And some of that brings into let's invest, and let's also invest in crypto or something too. So there's that group. Then there's a kind of budgeting people that show you how to make simple lunches and stuff. And then you invest in very simple, sensible things, and you make sure your super's in place and you've got your emergency budgets and you've kind of done a map. Then you've got the FIRE people who are the retirement folks who have spreadsheets and work out, okay, how much do you need to save or put in investments for you to retire by this date with this amount of money, taking inflation costs? So I think my response to you is, in terms of inspiring people, it depends on who and what grabs you. And it kind of, for some of the women, it was like their boyfriends sort of told them, and then they started a managed fund. And then they're like, actually, no, I want to learn a bit more too. So it depends on the person and where they are and what's happening in their life too. So there's a kind of digital financial cultures where some of the values match that kind of financialization of everyday life lit that Julie was talking about, but then kind of different ways that it's modulated according to different aesthetics, tastes, cultural groups and so on.
And at some point, these are also linked to disinformation.
Yeah, definitely. Yeah, and you could see that with the issues with crypto at the moment. Then the wellness space that I've been looking at, it's just disappeared. No one is talking about it. All those wellness influencers that were in Mexico dancing around, showing how great their crypto is as an abundance because money is energy, they're quiet now. So yeah, it depends on the group. Yeah.
Hey, Nat,
Hi.
I just wanted to somewhat
Yeah.
about that idea of the sophistication of what they're doing and kind of just hear your view. So they're kind of participating in these groups, right? From their mates, watching streams, podcasts. So I just wasn't quite sure as to what you were arguing. Are you suggesting that they're kind of involved in these sort of digital echo chambers? They're just kind of hearing versions of the same, potentially, advice in different forms, or are they getting a diversity?
Yeah.
Plurality of views that kind of last.
From the focus groups, it didn't get the sense it was an echo chamber. And there are ways that they will still be opening up the Money Smart website, or they'll be looking at actual really mundane information, like how well has a stock performed over a certain period of time too. So there's a kind of, I wouldn't say truth, but, there's a limit to, and they're also getting a sense of, what does it mean to be a stockholder of a company? And then these are your responsibilities too, where you get to vote in meetings and all of those sorts of things too. So some of the information was quite mundane, and I wouldn't say that it's that disinfo or whatever. And I'm always anxious when people say echo chambers, because participants always say other things start to come through. Like when I'm trying to study wellness stuff, I get the anti-wellness people, and on my personal feeds, I get the, so all of that. This algorithm does a little bit of teasing out, at least from what participants have said. But in terms of the learning and intentionally finding things that might be more critical, some of that happens and some of it doesn't happen. And I think part of that is because of how the platforms are shaping what learning can happen. Part of it is a kind of acceptance of financialization, and that risk is okay with the kinds of things that Ben said, that, that risk will pay out in the end. And some of it is that they're still young, and maybe it goes back to that question of the podcast host is, putting $500 in a month for some people's lives, that big a deal anyway too. So it's sort of a bit, it's just been interesting, the panic. And when I've spoken about this, or Ben has spoken about, people go, oh, it's so risky and it's bad and we shouldn't be doing these things, but people won't make that link to super as well. So I think super is the bit that's missing. I don't think I answered your question that well, but I think it kind of shows the messiness and trying to theorize something that still feels messy. Yeah.
Last quick question from Nat.
To what extent do the participants judge trustworthiness of the information that their peers online, groups, or algorithms?
Yeah. Trustworthiness is really interesting. When we were coding, our colleague Angel was coding for trust at the level of where they were talking about trust. And when we went back through the coding there, it was kind of the relatability stuff. Oh, this podcast host went to ANU. I'm studying at ANU. Therefore, they are like me and I trust their stuff. But that podcast was also sponsored by ASIC and has been part of lots of different things too. Trust was at the level of the platform. So this is more a sophisticated platform than this one. This Reddit conversation has more people that seem to know what they're talking about than this subreddit. So I'm going to pay attention to this one. But it really was that sense of, if I can collect enough information, I can make a decision about what's trustworthy. And there's someone who's written about this in terms of aggregated trustworthiness, trustworthiness as a process, not as something that an expert would have that therefore makes it trustworthy. I think it's that. If not, I will let you know. I can't remember the name of the scholar who writes about it either, because names and I Thanks. Is there anything else, Ben, you want to say about trustworthiness? Sorry. Yeah. Yeah, being too emotional. It's that same thing. If you're too emotional, you're not emotional enough. That was also outside of not trustworthiness. Like being excited that your stock's, that's okay. But being like, everybody now has to, that was, so that kind of in between space. Thank you. Sorry.
Thank you.
Okay, this is a paper, it's a speculative paper written with colleagues from the University of Bristol and the University of York back in the UK. If anyone wants to read some of the work that underpins it, there's an online report called Code Encounters, an algorithmic risk profiling in housing, which is basically a review of the literature. I didn't know whether anyone would be interested in this work in Australia, but the moment I got off the plane, the newspapers were full of a data breach from Harcourts, where rental companies have been collecting huge amounts of data on potential renters, and it had been leaked. And what interested me was that people were concerned about privacy. They weren't really concerned about why they were collecting the data in the first instance, and that's what I want to talk about today. Probably the emblematic platform in Australia that I've come across is a platform called Snug. If anyone has used Snug, you can upload data about yourself to Snug, and you can get a rental score that will function, it says, as a passport when you come to try and get a rental property. But I want to go back to the future, first of all. I want to go back to 2005, and I'm just going to show you a little video that was produced in 2005, because this is what we imagined was going to happen at that point.
Hi. Yes, I'd like to order. Yes. Thank you for calling in, sir. I should like a number 610-00999. Just so these work.
Oh, we can deliver spots on supply. But that one put the file like out yet?
No, I'm on my way home. How do you know all this stuff?
We got wired.
Well, I'd like to order a couple of your double meat special pizzas.
Sure thing. Still don't get you what they're charging.
What do you mean? What? $67. I live in Washington. That's how much?
Too late, really. It hasn't happened in the way that we expected for reasons I'm going to try and demonstrate. But the project, although it is about housing risk, is really located within a broader sociology of the algorithm. And you will know that there's been a huge literature on algorithms that have poured out just recently, books with titles like Machine Habitus, and about 6 books, I think, by my colleague Dave Beer, who's been writing about metric power and the tensions of algorithmic thinking. So this literature is everywhere across the social science, and it's very variable in quality, I think. It seems obsessed with one particular publication that came out in 1992, and that's Deleuze's postscript on the societies of control, which I guess some of you will be familiar with. 15 pages of relative coherence from Deleuze that is widely cited in the literature. But there are other frameworks. I'm going to come back to Deleuze, I'm afraid, in a minute, just a trigger warning. But Louise Amour's book, Cloud Ethics, I think is particularly useful. In her book, she observes that algorithms change the processes by which people and things are rendered perceptible and how they are brought to attention. And this leads her to explore the importance of the recognition and the recognizability of what she terms attributes, when seeking to understand the ethics and the power of algorithms. And we're going to use that notion of regimes of recognition and the mechanisms by which new algorithmic technologies come to constitute individuals and the risks that they might or might not possess. So this notion of attributes, I'm going to try and read through the Deleuzean notion of individual and the marketing notion of a segment. So just bear with me while we go back to 1992 and look at this little publication, Deleuze's postscript on societies of control. If you've not read it, I don't recommend you read the original. I do recommend you read a great paper from 2020 by Brizier, which is a 30-year update, trying to take account of the technological changes that have occurred since '92, especially big data and predictive analytics. Now, guessing that some of you are familiar with the paper, you'll remember that Deleuze draws a distinction with the Foucauldian notion of disciplinary societies and says that they are being replaced in an epochal sense by what he calls control societies. Control modulates, he says. Cash bonuses rise as workers speed more units down the assembly line. Managers receive stock options with value fluctuating to reflect the company's success. On our apps, we see our investments going up and down in almost real time. He juxtaposed this with the rigidity of a disciplinary society. We're always starting over in disciplinary societies. Life is a constant reset as we convert from the bedroom to the kitchen to the workspace. Appropriate shoes are donned for work, later jeans because it's leisure time, then pajamas if you wear them for sleep. In control societies, things never begin or end. We're always in the middle. And in a sense, COVID clearly accentuated that. We don't know whether we're coming or going, or whether we're working, or whether we are consuming or in leisure time. And in disciplinary societies, we constantly reach for forms of identification. It allows us to drive our cars, get into bars, confirm the credit card is ours at the end of the night. In a controlled society, the password is key, a combination of letters and numbers. And now, as I'm going to argue, our face is increasingly our password, or if not our face, increasingly is our face, other forms of biometrics. Now, the broad cleavage for a disciplinary society in Foucauldian terms contrasts the individual against the mass. Paradigmatically, I suppose, the capitalist opposes the worker. In control society, the fundamental divide contrasts the individual against what Deleuze calls the dividual. The dividual is the me that results from the summing of all the data sets to which I belong. Production anchors the economy in the disciplinary society. Going to work in the morning means contributing to the fabrication of goods and the offering of services. The impetus to consume is need. Advertising, what Deleuze calls the joys of marketing, it's going to be important, drives the control economy. People go to work to sell. The impetus is consumer desire, which may be found and leveraged or created and exploited. The transition from the card to the password that Deleuze notes has continued evolving towards facial recognition. In a sense, the face is the perfect password, impossible for the possessor to forget, and it does not matter whether others discover it. Obviously, you can see people's faces. More, it's a combination. Going back to a physical ID like a driver's license or a passport, the logic was the picture on the card corresponding with a name and a description, and together they connected with a holder. There is an identification triangle. A password obviates the need to connect the identification with a holder because the password directly invokes the subject. It's no longer a question of visual resemblance, but of unique knowledge. So 3 points now reduced to 2. Finally, with facial recognition, the identifier is the holder. The password is the person. There is no longer any distinction at all. I am my own identification, my own password. The convenience gain is significant, but the cost has increased the difficulty of escaping identification, regimes of recognition. In today's camera-laden world, we are revealing our password everywhere we go, as Palantir and Peter Thiel know. Deleuze outlined this distinction in disciplinary societies between the individual and the mass, where, as I've said, the issue was really to do with the superhuman, the threat of being subsumed within a mass of others, where a little differentiation occurs. Within a control society, Deleuze suggests the issue isn't to do with the superhuman, it's to do with the subhuman, it's to do with the individual, it's to do with the fragmentation of self based upon the various data points that we inevitably contribute to. Okay. So this notion of individual within Deleuzean philosophy is broadly equivalent to the notion of the segment within marketing technologies. And for the last few years, I've been working on the history of segmenting technologies. And at a very appropriate time, Steve sent me a great paper, The Person of the Category, the Pricing of Risk and the Politics of Classification, Insurance and Credit, which is a sociological history of the development of kind of pre-digital technologies for risk assessment in the insurance industry and the prefigurative notion of the individual within credit scoring. Now, the difference is quite subtle. In insurance risk assessment, essentially clusters of similar individuals are put together in real ontological groups and some kind of a probabilistic assessment is made. Contrast that with the history of credit referencing scoring, where the different attributes that we possess are all added up and we get a credit score which might or might not be shared with other individuals. Two individuals can have the same credit score, but it could be arrived at by a completely different combination of attributes. Contrast that, however, with the notion of the segment and the technologies that segment population. This is a technology that puts people together who are self-similar based upon a plethora of different data points. If any of you are interested, it's contained in a book called The Predictive Postcode, which is a history of clustering technologies within marketing. In particular, a technology called geodemographics, which is able to use a whole range of different data sources in order to cluster individuals and households into a set of exhaustive and mutually exclusive categories. I won't go through the history of this technology, but it begins with Booth's mapping of London in the 1900s, gets fed through the Chicago School, and then goes to the machinations of various statistical procedures that leads in 1971 with the census being used to cluster individual postcodes into different types. It then accelerates by the use of transactional byproduct data. Then big data is included within these classifications. And now the technology I want to talk about here, we now move away from data about postcodes and residential addresses to phone data. And the truism, I suppose, is the case that you are no longer where you live, you are where you go. There's the history. This is what results. Essentially, in the UK, every individual household is classified into one of, I think, 67 at the moment, mutually exclusive and exhaustive categories. This is what Mosaic does for your country, our country. You will be, if you had the money, able to locate where you are socio-culturally coded by the Bourdieusian scholars who work for the marketing industry and classify you based upon a whole range of data, both official and commercial. It allows you to very precisely pinpoint the socio-cultural class, if I could call it that, within space, quite a precise level. Indeed, now in both the UK and in Australia and in America, down to a granular level of the individual household, each is geocoded, and a risk can be associated with that type of location. Here are some of the visualizations of the different groups of people so coded in the UK. Crash pad professionals, the name Marco and Christina are statistically overrepresented within that group. The risks of any kind of outcome can be assessed based upon that postcode, including the risk of falling into mortgage arrears or failing to pay rent. That's old technology, however, still terribly useful to political parties and marketing organizations. But now the big money is on mobile phone data, because it turns out that where you go is a better predictor than where you live. And indeed, we don't even need to know your postcode anymore, because we can see that the phone is relatively stable for 7 or 8 hours in every 24-hour period. Now the cluster analysis appears on the phone rather than about the address, and where you move can be very precisely mapped for other reasons. But you get the idea. As Bev Skeggs also points out in her wonderful talk, you're being tracked, evaluated, and sold. I won't let her talk. Essentially, the phone becomes an instantiation of habitus, based upon the apps that you use, based upon the various streams of music that you listen to, based upon what you've been reading. You're clustered, I think, at the moment to one of about 210 different types, and then you move around the city. Tracked mobile habitus, social media segments are being geolocated, and predictive analytics identify strong correlations with potential default, but with little theoretical rationale for why. And I'll explain why those books are there if anyone is interested. Housing, very quickly. These new regimes of recognition in algorithmic risk profiling in housing are coming upon us more quickly than we can actually react to them, I suggest. Housing, as we know, is an obligatory passage point in an ANT sense, but for accessing other income and debt streams. You know, where you live and your tenure status becomes important. But what I'm suggesting is that we're seeing a shift away from traditional individual measures, the old technologies of credit referencing and so on, and existing schemes are being supplemented by new developments in fintech and possibly superseded by big data systems which have their origins in marketing. The segment, the individual, becomes the important attribute, not least because it means that you don't have to be explicit about data that you're not allowed to use within making these critical evaluations based upon law and systems of regulation. There's a new ordinal register being developed based upon combining various segments of risk data, new forms of what in this wonderful book, Investee Politics in a Speculative Age calls rated agency. I love it, rated agency, which uses synthetic measures that themselves are constructed from multiple variables. And as I've said, it sometimes bypasses the legal status of variables that can't be used in order to evaluate credit risk. So geodemographics and geolocated segments from the marketing industry are now coming in to be used in terms of risk assessment in relation to the sorts of evaluations that we might be interested in. And all that's needed often is the address and the mobile number, which allows you to be classified and can be updated as new data sets emerges. They're interested in social media and streaming feeds, segments and clusters that define a habitus that can then be monitored over time and space. You know, it raises the question that people's musical tastes might be predictive of future mortgage default. What do we do about that? We know what to do at the moment in terms of what we're supposed to do in terms of getting a good credit score. But if listening to music in your 14 and 15-year-old persona links in, then we have a problem. I'm also interested in the interpolation via gamification that you touched upon, and I've got some videos if anyone wants to see them later on. So housing, what sort of data am I talking about? Well, again, it's already been touched upon in the UK. I don't know about Australia, so do tell me. We now have data on the future income of every degree in every institution in the country. So we have the future prediction of the odds of anyone with a particular degree from a particular institution earning above or below average salaries. So, for instance, if you did sports science and you're a female, better to have done it at the University of Exeter than the University of Lincoln in terms of your future earning potential. That's the sort of data that the companies who are now providing the risk profiles might be interested in. Coming back to the wonderful work that you've been doing in terms of intergenerational wealth transfers, it's no longer a matter of just assessing the risk of the individual. It's now assessing the risk of what I called earlier the Minskian household. They are certainly aware that they can formalise data on the parents and the grandparents. I think what they don't know yet, and perhaps we shouldn't tell them, is that there are also other transfers of income from elsewhere within the household. So increasingly, the object of inquiry moves away from being the individual to becoming the household in terms of the evaluation of risk. This leads to the production, I'm nearly finished, of rental passports. The idea that essentially, rather than every time you go into a new rental having to get more references and more data, you have a passport based upon the accumulation of all of this data. The rental histories, and perhaps this is one good aspect of this, then feed into your ability to access a mortgage as well, which didn't ever used to be the case. So we're seeing the development of things like tenant passport schemes. Some of them are card-based. Soon they'll be through app-based facial recognition systems. Snug in Australia, if you've not seen it, it's worth having a look at. You can update your rental reputation by providing access to more and more information, including open banking, which will allow Snug to look at the income flows in and out of your Commonwealth bank account, now all of course coded by whether it was for beer, gambling, rent or investment in ways that themselves can be clustered. A couple of videos I'll go back to if people are interested. These are adverts from Experian looking at how you can boost your credit score by allowing open banking and the way in which you can use your rental income to access mortgage materials. And I think as a debate, the papers today were absolutely great about investment. And when we think about the gig economy app development yesterday, it does seem to me at least that these things should be looked at in the round. The data from investment and from the gig economy feeds through to the overall social credit scores that feed into risk assessments in relation to access to mortgages and rental apartments and such like. the obligatory passage points. The app uses open banking, showing income expenditure flows, and we need to better understand the overall ecology of digital platforms in the round and how they connect with each other. Perhaps that's why they're not making any money at the moment, because they're a big data extraction machine. And that ecology of digital platforms and how it relates to notions perhaps of rentier capitalism. So, Chinese social credit under conditions of neoliberalism. Here we come. Don't know if any of you have seen Black Mirror and Nosedive, but I think we're quite close to that situation. Thank you very much.
Thank you, Robert. We have questions for that presentation of dystopia. My first question is, how much do those poor GC scholars get paid by the insurance industry?
About 2.734 times more than the average salary in academia.
I put my hand up tentatively because I feel like I'm going to take myself track and to ask a question before we go for it. My area is like human and community services, especially spaces like youth justice and child protection. And as you were talking, the risk assessment stuff, I mean, that is what happens in health and human services. And when we look at health and human services practitioners in areas like child protection, filling out these complex risk matrices that punch out a score. That score, tells you that you're going to have a caseworker for intensively for 10 hours a week, or someone's going to phone you once a month to check in on the safety of your child. And it's the same principles of this. I mean, I can really see how, and things like the postcode and socioeconomic status has really informed a lot of those health and human services risk assessment processes. And I just kind of see the future of this, that neoliberal stuff, and continuing to move into that space.
Well, I mean, I think that's the case. I mean, in a sense, let's call it social credit for the sake of argument. Bills from birth. In a sense, you inherit the scores from your parents and your grandparents. Then you have school outcomes, and then you have criminal justice outcomes, and then you have any of the other digital data that occurs. But it's data that doesn't really. It's not your data, it's the data that you contribute to a segment. That's the whole issue. And the segment, of course, relates to a probability that can only ever be an attribute of a group. An individual doesn't possess an individual propensity towards anything. So it's always to do with the future actions of people who are not yourself, but nevertheless feed back into the systems in order to allow you a kind of an ordinal access to mortgage and rental markets, and I would say many other income and debt schemes.
So I'm curious about, I suppose, whether there's any possible way to kind of game these types of systems or opt out of them in any way. Because I'm assuming that even if you don't use Spotify or wherever they're scraping the data on musical taste and that type of thing from, that in of itself is data or puts you into a group. Is there any escape from the entanglement?
Well, you cannot engage with the technologies that leave digital traces, but that just allows them to impute you're the sort of person who doesn't like to leave digital traces, which will allow them to impute probably whether you're a vegetarian or not, how you vote, and a whole range of other activities as well. So sparse data points are often better predictors of poor creditworthiness than anything else. So you can have a go and you can try and subvert it a little bit. But I think the issue is, and one of the reasons I had the novel there, Gravity's Rainbow, I don't know if any of you have ever read Gravity's Rainbow. It's about many things, but it's also to do with the problem of predictive analytics. Roger, the character in the book who's a statistician, is charged with trying to understand where doodlebugs are falling across London in the Second World War. And he's doing various calculations, looking at kind of, temperature, wind direction, weather, and he can find no correlation at all until he realizes that actually they're all falling within a quarter mile of where he last committed adultery. And there's no reason for why that pattern occurs, but the data set is big enough to actually allow there to be a strong correlation. And we're in a situation where actually it's unclear where we go, what we do, what we study, and all of the other things that contribute to the segments that have a theoretical rationale for why it leads to other people with a similar characteristic not paying their mortgage or not paying their rent. But nevertheless, it will be imputed to your situation and will be flagged as such. But we don't know what to do because we don't really know what is predictive of the outcome. So we can have a good guess, but in some instances, listening to certain sort of music has no real rationale for why you wouldn't pay your rent.
That's my for stuff. Obviously, it's more scary to hear. Based on previous research and stuff that I'm thinking about in the future as well, I'm seeing and hearing how this sort of perpetuates redlining and how decisions are being made about different areas and value for their lives and how social issues are addressed based on individual choices, but also outside of choices. Do you have data on that?
Yeah. Yes, I mean, of course they don't like it being called, redlining, and it's far more subtle than it used to be. It's not just a spatial redlining. It's not just particular streets. It is a socio-spatial ordinality that results from very complex segmented data derived from a range of different outcomes. I mean, in a sense, it provides data which allows for more nuanced products to be directed towards one. You might pay a slightly higher interest rate or a slightly lower interest rate depending upon the score. I think that the issue really in rental markets, however, and this is where Snug is interesting, in the UK, and I think in some cities in Australia as well, you've often got 10 or 11 people competing for the same rental. And way more than 10 or 11. Well, we see. So this is advertised as a way of actually giving an ordinal ranking to all of those individuals, because you don't want to look at half of them, because from the landlord's point of view and the platforms that you use, especially by the corporate landlords, this is a machinic intervention which allows you to save huge amounts of time by having to collect data on all of those individuals. So it becomes literally a social credit. It becomes a ranking system, and it is about the sort of strategic conduct that I mean, in a sense, that's where Deleuze is, or an updated form of Deleuze is correct. It is about trying to modulate and moderate in real time your actions and your behaviours in order to look at, through the gamification systems, you can look online and see what your Experian credit score is and what you might need to do in order to improve it. The issue I suppose I'm raising is that the old traditional credit scoring is now being supplemented by fintech, prop tech, and other forms of digital technologies, which aren't subject to the constraints, regulatory and otherwise, that the credit referencing agencies have been subject to.
I'll take one last question before Tom.
So what's the relationship between August and the state?
That's a very, very interesting question. I think for a long while, the data brokers, companies like Experian and now companies like Palantir, have had far better real-time data than the state. I mean, it's interesting. There's been some work done looking at the relationship between kind of official statistics, so the use of official statistics like 10-year census data points. Well, 10 years is no good to anyone in relation to this field. So, I mean, they're interested in regulation, but they're not able, I think, to compete with essentially big data organisations, which are essentially from the commercial sector. And the political economist Will Davis has written about the decline of national statistics as a legitimator, and the way in which people, members of the public, for the most part, feel more comfortable with the gamification of data with which they are familiar through Facebook and Twitter and other kinds of technologies that give them a kind of a recursive sense of themselves. That's why I think we have to be interested in the platform more broadly. and this sense about platforms not making money, because it is in a sense the ecology of the platforms, the gig economy platforms, the investor platforms, the betting platforms, the rental platforms, your Amazon, everything else. I think it's coming together within a complex kind of ecology that in a sense has given us a real-time statistical visualization of who we are and what we're doing that the state is a million miles away from at the moment. And of course, you know, it does link into, because many of these organizations are owned by billionaire libertarian cryptocurrency fascists, and it's problematic. They're interested in bypassing the state in various ways, I think, and collecting data that might be related to national borders. But I think they'll be just as interested to know that I'm in Australia as that I was in the UK. They'll be interested in my movements across the world, because that will help them to segment more precisely the risks that I won't pay my mortgage, because it will shift me into different segments and different clusters. Okay, thank you.